After reaching its highest level in 6 months during July, search traffic for truck driving jobs fell by 6% month over month in the first half of August. Though the number of people searching for truck driving jobs did decline, those who were still searching did so with greater intent. Heading into Labor Day, the week-over-week load volume and spot rate numbers ticked up week over week for the first time in several weeks, while still falling short of last year's numbers. J.B. Hunt, Kodiak, and Bridgestone began teaming up on a driverless haul program in January, and recently the collaboration surpassed 50,000 autonomous long-haul trucking miles. And finally, we'll check in with our good friend Jason Miller for his outlook on the economy and see if he thinks we may finally be in for better times or just more of the same. For Randall Reilly, I'm Joshua Miller, and this is the 30-Day Reset. Hello everyone, and welcome back to the 30-Day Reset. We did have to take the show off last month as we were in the middle of moving offices and studios, but we're back in this month in our new spot with a new setup. Every month we're back here with all the latest driver recruiting, freight, and economic data, as well as a news story. So if that's something you'd be into, don't forget to like, share, and subscribe to our YouTube channel. You can also subscribe to our monthly newsletter for a sampling of our latest written and video content over on our website. And if you want your own copy of all the data covered in today's episode, you can find a link in the description on YouTube or fill out the form just below the player on our Randall Reilly site. Everything that we covered today will be featured right there in that download, and it'll go into a little bit more detail as well. Now, let's dive right into it. First up is Trucking by the Numbers, brought to you by Stratus Strategize. As mentioned in the open, the August search numbers took a sizable 6% dip, but the intent of those searching was still relatively high. There was also a fairly high year-over-year discrepancy for August, but most of that was due to the shutdown of Yellow Corporation at the end of 2023, which resulted in about 30,000 layoffs, with most of those being drivers. Throughout July, the average CPC for search, social, and display all dropped and had some of the lowest levels on record. Though the first half of August, social and display CPCs look on track to continue dropping, though search clicks have begun to creep back up. The social CPC looks to be closing in on its third lowest cost since August of 2020, and display CPC is on pace to drop by 9% month over month and reach its most cost-effective level since February 2021. And search cost? Well, that's on pace to rise 11% and hit the highest levels of the year. When it comes to lead costs, those continue to inch downward month over month, and though the overall costs are relatively stable, the segment costs have had some pretty significant shifts. For instance, owner-operator cost for August is up 12% following several months of stability, while team company drivers CPL fell by 9% in July. On the CPH side of the equation, company driver CPH fell by 6%, while owner-op campaigns saw a 17% rise through the month of July. And that CPH for company drivers comes in at the lowest point since January. As far as the freight side of things, the load volume and spot rate numbers were both up week over week for the first time in several weeks, but both of those numbers still lag behind the year-over-year and 5-year averages. Overall load volume was down 7.6% year over year and came in 35% below the 5-year average, while spot rates were down 3% year over year and 11% when you compare it to the 5-year average. As far as the individual segments go, dry van loads were up nearly 8%, while spot rates dipped by 4% year over year. Refrigerated saw a decline in load volume of 13%, and spot rates fell by 1.7%. And finally, flatbed load volume ticked up 4.5% year over year as the spot rates decreased by 3% year over year. Now for this month's news story. Back in January, J.B. Hunt Transport Services, Inc., Bridgestone Americas, and Kodiak Robotics teamed up for a weekly driverless delivery collaboration. During the partnership, over 50,000 autonomous long-haul miles have been racked up. Using Kodiak's autonomous hub-to-hub delivery model, J.B. Hunt trucks bring trailers to and from Bridgestone facilities and Kodiak hubs. The ongoing partnership has provided a round-trip solution for delivering Bridgestone passenger car tires while minimizing empty miles to improve efficiency. Bridgestone's Vice President, Logistics, Operations, and Product Delivery, Brad Blizzard, had this to say about the initiative. As part of our ongoing evolution into a global leader in sustainable mobility solutions, Bridgestone joined forces with Kodiak and J.B. Hunt to prove that autonomous long-haul shipping is more than just a daydream. It's happening right now. We are excited to be expanding our roots, growing this partnership, and investing in the mobility of the future. Now, let's check in with our friend Jason Miller for his thoughts and our economic update.
Welcome everybody to our late August, early September update for where things are at in the freight market. Leading us off, it's turned out that the increase in spot rates in the dry van sector that we saw in June was not the harbinger of a true change in market conditions, but it actually was just typical seasonality. On the left, we can see, in red, spot rates have come down. Right now, they're ending August at about $2.01 per mile average. Broker buy contract rates from DAT, they're up at about $2.40 a mile. That results in a very large spot market cycle indicator reading, where we take the difference between the two and divide by the average, with contract minus spot being the numerator. We can see as we're right now at about 17.7% for August. That is far above the historical 10% threshold that has signaled a bull market. So what I would tell you right now is it is increasingly looking like it's time to write off 2024 as the possible year where the spot market turns. The biggest reason for that, other than strong capacity, is just, excess capacity, I should say, is just the fact demand is remaining continually muted right now. So the trucking 10-mile index has us moving along the bottom of the trough. June was a bit of a disappointment with a seasonally adjusted drop. Given a major slowdown in the auto sector that we observed in July, I'm anticipating that July's reading will also be quite weak, if not down on a seasonally adjusted basis. And you can see we're just, moving along sort of at the bottom of this trough freight demand, and we're now realistically over 2 years into the freight recession, if you want to say that, late Q2 of 2022 is when that began. Now, the weakness this year, I think, has come as a surprise because containerized imports are up substantially. Year over year right now, metric tonnage of containerized waterborne imports per the Census Bureau's data are up 10% year over year. This is a very odd period in that historically strong import increases have also tended to correspond to strong increases in trucking ton mileage. And conversely, declines in imports can correspond to declines in ton mileage. We're just not seeing that right now at the moment. That this is mirroring essentially where we were at in 2015, where we were seeing year over year declines in ton miles, but also imports had been up substantially. So this is kind of a repeat of that. And when we dive into the data, I think the explanation for this is the mix of containerized imports, and this is focusing specifically on imports from Asia because that's where the big volume growth has been, is that if we take a look, I've highlighted several different product categories for which we've had increases through the first 6 months of 2024 relative to 23, 22, and 2017 for the first 6 months of those years. Where you can see those gains are is in things like plastic products, which are mostly intermediate inputs to other production processes, as well as basic chemicals. The real standout is in semiconductors and other electronic components. The big factor here is solar cells. We see other general purpose machinery. Imports have been very, very, very strong. So that's capital investment. And then electrical equipment and components, that specific sector is corresponding to EV batteries and parts. And so what we're seeing here is that the strong growth of imports is more in inputs for other production processes. They're not in consumer-oriented goods. For example, the miscellaneous manufactured commodities, while up substantially from last year, is down over 600,000 metric tons from where it was in 22. That includes toys and exercise equipment. And so right now, as we move through the rest of this year, barring something very unexpected, let's say a prolonged port strike, which would make things a little spicy, it just seems that we're not likely to get a sustained either disruption or increase of demand that would be what it would take to really kick spot prices into gear. So not the news everybody wants, and unfortunately I've sounded like a broken record with this year, but that's kind of where we're at.
Thank you so much for that, Jason. We really appreciate you taking the time to share your thoughts and expertise with us. And with that, that'll just about do it for us here on another edition of the 30-Day Reset. Now, don't forget, you can get your copy of all the data we covered today, including the slides featured during Jason's economic update in our 30-Day Reset download. That, again, is available in the description if you're over on YouTube or by filling out the form if you're watching us over on randallreilly.com. And don't forget, like, share, subscribe, sign up for that newsletter, and all that good stuff so you never miss out on any of our new content. We look forward to seeing you here next time for another all-new edition of the 30-Day Reset. Thanks for watching.